Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The IMF raises its global economic outlook for the first time in a year, but it predicts the UK will be the only G7 member in recession in 2023. France unexpectedly grows in the fourth quarter. GDP rose 0.1%, boosted by investment and net trade. We turn our attention to the euro area figures out at 11 a.m. And UBS tops estimates and announces a more than $5 billion share buyback. The chief executive, Ralph Hammers, says shareholder returns are an important part of the business strategy.
If we can grow, we will grow. If that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback, and we have confidence that we can buy back over $5 billion in this year.
Let's check on the markets. The pictures across equities is one of actually a downturn. So we're seeing futures in the US, we're seeing European shares down. Investors positioning for interest rate hikes this week from the Federal Reserve, but also the European Central Bank. Now, the sell-off in Adani Group also continues, with 10 of the conglomerate's companies seeing about $75 billion in market valuation erased. And there's a beautiful piece by Shirley Wren, basically says, watch out for second and third round effects. If there's a margin call, then this is something that could go down quite well in an ugly manner. We also look at data, of course, here in Europe. We had not only that French GDP, but we look at the overall Eurozone a little bit later. That's at 11 o'clock UK time. This is the picture across the board for a lot of the European stocks. Now, handing over everything, of course, is Wednesday's Federal Reserve decision. The US Central Bank widely expect to raise rates by 0.25 percentage points, and then investors will be watching for tones from officials for future meetings after Jay Powell's consistent efforts really to push back against traders anticipating rate cuts later this year. U.S. and European stock futures and Asian shares falling today, as we were just saying. Investors positioned for interest rate hikes later this week. So let's get straight to it. Let's get to Meera Chandan, JP Morgan co-head of global FX strategy, and Bloomberg's Christina Aquino. Thank you both for joining us. Meera, great to speak to you today. What are markets getting wrong in this kind of environment? Are they expecting too much from the Fed, that, you know, we hike, we're at peak inflation, and then they cut at the end of the year?
Yeah, absolutely, Francine. I think that's the big risk here, is that the market is putting too much weight on the Fed delivering rate cuts at by the end of this year. And I think the one thing that Jay Powell, as you mentioned, will push back on today is actually that market's pricing. Whether the FX market actually responds to that is a whole different story, but certainly that's the line that he will be towing.
Is there anything underlying some of the concern of what markets don't understand? I don't know whether it's a neutral rate, and the neutral rate is difficult to define and keeps on moving.
The key issue here is that some of the survey metrics that we're seeing from the U.S., some of the data are actually showing that the probability of recession is pretty high. And there's an underlying belief that the Fed will step in, inflation is going to cool, and the Fed's going to step in to support growth. And that's really the key source of contention. The problem here, of course, is, and what the Fed is highlighting and what we've been saying, is that inflation is actually not going to come off to the extent that the market expects. So that could actually cause the Fed to stay on a high, at a high interest rate level for a longer period of time.
And Christine, I guess you look at that and you also put it in the context of earnings, and better than expected earnings in banks, but a lot of them were priced in before.
Absolutely, Francine. And really, for earnings season, what you really want to look at is all the outlooks that banks and really all companies are delivering. And it really points to quite an uncertain and bleak future, right? From all the cost cutting and layoffs that we've seen, as well as just any effort by companies to really keep their ships tight, because it's going to be an uncertain, stormy period ahead, and they really don't know what's going to happen. Maybe we go into a recession, maybe not, but you really can get the sense from this earnings season that companies just want to be prepared for the worst case scenario while hoping for the best.
I mean, was there too much of a rally in January? And this is one of the questions. Maybe markets got ahead of themselves looking at earnings. Was that really realizing what it went for market share?
Yeah, I mean, there's definitely the question of, have we gone too far? But, you know, given that 2022 was really such a terrible year for most asset markets, right? January was bound to be a bit of a bounce, right? But I think February is when markets will really have to come face to face with the reality that we're in, which is that inflation is still high and central banks are still struggling to contain that. And really, it becomes a question of how much can central banks tolerate inflation while they've come down from all-time highs that we've seen, will still be above target. How much tolerance will they have for that? And that's really the big question.
The big question. Terminal Fed fund rates. What do they tell us about what happens to dollar from now on?
Look, the terminal Fed funds rate is around 5%. The dollar itself is not just about the U.S. When the market was repricing the Fed, it was obviously in large part the dollar strength was about that repricing. I think there is a second important ingredient to dollar strength or weakness, which is what is the rest of the world doing compared to the U.S. And the big difference here is that actually China and European growth is beating expectations, doing much better than expected, whereas U.S. is slowing down. So really the Fed doesn't really have much ability to change that picture. So I think you could have a situation where so long as China is growing well and Europe is growing well, even if the Fed is hawkish, actually the dollar continues to weaken because it's focusing on growth rather than the Fed.
What exactly are you expecting from Jay Powell? Is he going to push back against some of, the I guess, looser financial conditions that the market narrative seems to be pushing?
Absolutely. I mean, I think there is a pushback that should come against the market pricing of rate cards. There's the fact that we've had an easing in financial conditions. It's the opposite probably of what they want. But like I said, there's not much that Powell can do to change the growth picture globally. And this is being driven by very real factors. The dollar weakness is being driven by very real factors outside the U.S. What they could do is try and take some of the froth out of the equity markets. And that's why we do think that there is going to be a hard line that he adopts. But at the end of the day, market's going to focus on inflation coming off in the U.S. and the Fed coming to a pause.
Yeah, and Christy, if you look at IMF, I mean, they were much better than expected overall for forecasts going forward. And this is thanks to U.S. strength, but also the China reopening.
Absolutely, Francine. And it is quite fascinating because you have the two world's biggest economies kind of really holding up, again, the baton for world growth, right? The idea that the U.S. avoids a recession, definitely good news for the rest of the global economy. But then added to that, of course, the China reopening. I mean, we've definitely seen any economy that's coming out of lockdown really get that bounce. And I think that could be quite a powerful catalyst, or at least a cushion for world growth, given that 2023 is going to be a challenging year. And as Mira pointed out, I think that's going to be particularly good news for Europe, given that it is quite levered to the Chinese growth story as well.
Mira, what's the most interesting currency right now? I mean, yen? Although sterling is certainly not dull.
Oh, no, none of them is dull right now. That's the one thing we can say about currency markets. They're not doing what one might expect, but it's not far from dull. Look, I think yen is super interesting because the BOJ is on a path of policy normalization that will unfold over a multi-quarter period. We're not done with it yet. We expect another shift in yield curve control by mid-year this year. They come out of negative interest rates next year. So there is a path here for policy normalization, whereas the Fed is actually going to be slowing and staying on hold for a long period of time. So the expectation is actually that dollar yen should continue to weaken over a multi-quarter period. You know, we're thinking probably the low 120s is not unreasonable.
Yeah, for yen, is there a danger again that the market is already pricing everything in before we even have the appointment of a new central bank governor?
I don't think it is. It is, if you look at the way dollar yen's moved, it's perfectly explained by the changes in U.S. yields and changes in Japan yields. And I think if we expect more of a convergence there, I think there is more space here, particularly if you're talking about U.S. recession risks as well. I mean, the dollar tends to weaken versus other reserve currencies in that kind of scenario.
Yeah, and there's plenty of things going on, of course, with the Bank of England. So that's Thursday. And then we had this pretty incredible piece from Bloomberg Economics saying the UK economy is losing £100 billion because of Brexit.
Absolutely, Francine. I mean, when you look at it really, the IMF report, the cost of Brexit, the UK is really quite the laggard in a lot of ways, right? And we know that the reasons why is just because it's battling this cost of living crisis, the cost of Brexit. And of course, we have just labor strife as well that's currently going on with all the strikes. And so it really is quite a challenged position. You can understand why the IMF thinks it's going to be the only major economy hitting a recession this year.
Yeah, what does this mean for sterling?
it's not good. Recessions are never good, particularly when your major trading partners, such as the Eurozone, now looks like it's going to be avoiding a recession. And I think the key issue with the UK is that labor markets are incredibly tight. The supply side measures are incredibly constrained. And as you said, the growth picture is probably the most lagging of any other European economy. So from a fundamental standpoint, we are underweight sterling, looking for it to underperform euro. The only thing is, in the near term, this is, this does benefit from the general optimism that Europe is going through right now. But I think the fundamentals are actually quite weak.
Mira, thank you so much for joining us. Mira Chandan, JP Morgan co-head of Global FX Strategy, and Bloomberg's Christine Aquino. Coming up, more economic data out of the Eurozone, including the latest inflation print and GDP numbers ahead. Implications for ECB's decision on Thursday? Well, there are plenty of implications, so we'll discuss those next. And this is Bloomberg. A slew of economic data today ahead of the ECB decision on Thursday. In France, inflation came in at 7% in the year to January as the economy grew 0.1% the fourth quarter. We're also just minutes away from the CPI print for the wider euro area. Joining us now, Europe correspondent Maria Tadeo in Brussels. So, Maria, good morning. What are the French readings actually telling us?
Yes, Francine, and a lot of data coming today, kicking off with the French economy. You did see growth in the final quarter of the year, 0.1%. They avoided, therefore, a contraction. Of course, it's not fireworks growth, but if you compare it to Germany yesterday, there's some relief there. On the inflation picture, you've had on an annual basis inflation accelerating 7%. But of course, again, this is a general theme across the euro area. This has to do with the energy story. It was a very challenging year for all the reasons that we've talked about on the show repeatedly in 2022. However, going forward, there are two big question marks when you look at the French economy. One is definitely the strikes. The French president, Emmanuel Macron, has made it clear he wants to get this pension reform going. He wants to get it done, but that means more strike action. Today, we're expecting some more. And then when it comes to inflation, I think it's already made very clear by the French finance minister. You spoke with him in Davos that the idea of let's subsidize everything, let's pay for this is cushion the impact. The government wants to be more targeted in 2023, so that could in some ways accelerate inflation even more.
So what does all this economic data mean for the ECB decision on Thursday, Maria?
Well, Francine, overall, if you look at the inflation print today in France, if you look at the inflation print in Spain yesterday, which was a blowout number, although we should always clarify that Spanish inflation, it gets treated differently. The methodology changed yesterday, so treat that number carefully. But overall, it does point to inflation that continues to be way above target. And if you look at the language from Madame Lagarde in the past 2 months, essentially, she's repeated, we're not done yet. The central bank's single mandate is to bring it back to target. On Thursday, the market has fully priced in 50 basis points hike. The real debate is March, but given the data here, you could argue the hawks will make a case that inflation is not over. This is not hit and remove. This is hit and stay the course, so pave the way for another 50 basis points in March. That's a real debate.
Maria, thank you so much. Our Bloomberg Europe correspondent, Maria Tadeo. Coming up, Brexit costing the UK £100 billion a year. That's the finding of new Bloomberg analysis 3 years after Britain left the EU. More on that next. This is Bloomberg. The IMF forecasts that the UK will be the only G7 country in recession this year and will have the slowest growth of its peers in 2024. This comes as Bloomberg Economics reports that Brexit is costing the UK economy £100 billion a year. For more, we're joined by Bloomberg's Dan Hansen, who of course is one of the authors of this report. Dan, what more did the IMF have to say on the UK economy?
So I thought the IMF forecast was pretty interesting, actually. I mean, it's brought its projection further in line with what we're thinking about the UK at the moment. So we think there will be a recession in the first half of this year. We're a little bit more optimistic about how much output will fall in 2023 than the IMF. So we've got a 0.4% contraction. The IMF have got a 0.6% contraction. But I think actually what's really interesting, and it sort of plays into the Brexit story here as well, is how weak the recovery is moving into 2024. So the IMF have got 0.9%. We're more pessimistic than that, in fact. We think the economy will only grow by 0.5% in 2024. So we've got this very weak 2 years where the broad story is one of stagnation for the UK.
So, Dan, this also big piece of analysis that you did at Bloomberg paints this gloomy picture for the UK economy regarding the hit from Brexit. What have you found?
So we looked at sort of the impact of Brexit through a number of angles. There's the sort of classic angle, just looking at the headline impact on GDP, and that's the number you've said there, this £100 billion number, which is essentially that we think the economy is about 4% smaller than it otherwise would have been had it remained in the single market. And we've looked at other angles as well, so the impact on investment, which is well known, the impact on uncertainty has come through and really damaged investment in the UK. Trade as well is a little bit weaker, though it's not quite as weak as we would have expected. You'd expect that to be one of the key channels through which Brexit affects the economy. And of course, migration as well. So we've had migration has been weaker, certainly from EU migrants. EU employment is weaker than the trend going into the point at which the UK left the single market. And I think the broad takeaway from this is that the impact of Brexit has come through far quicker than we'd expected. So most forecasters, including ourselves, expected a sort of slow burn shock, if you like, something that affects the economy but over quite a long period of time. But actually, these numbers suggest that it's come through quite a bit quicker. And the risk is that there's more to come, of course. So that's the sort of key takeaway from what we found. And yeah, that note is on the terminal this morning.
Dan, I mean, you basically argue that the economy is 4% smaller than it might have been otherwise. Are there any steps that they can do now to reduce that shock?
Yeah, I mean, that's a really good question. I mean, I think what the problem the government's had, and there is definitely some sympathy here, is that you've experienced these two enormous shocks in the interim. So you've had Brexit going on in the background, but we've had the pandemic. And of course, we've had this enormous energy shock as well. So there are these two shocks that the government is having to fight. And I think what's really important now is that the attention turns to sort of making Brexit work. And this analysis that we've put out, it demonstrates that there's quite a long way to go to make things better. And I think the challenge here is that when you leave, you change your relationship with your biggest trading partner, which is the EU. And a frictionless agreement you have with the EU, you have to try and replicate and sort of make up for that in other places. So it is really important that other trade deals are forged in time. But the question really there is whether they can truly compensate. And I think from where we sit, the net effect of this is going to be negative for the economy. But there are, as I say, there are steps the government can take, and it is really sort of trying to find ways of compensating for the loss of access to the single market.
Dan, thank you so much. Dan Hansen with the very latest on this very important Bloomberg economics piece. We'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. A reminder, this Thursday, it's also Bank of England Day. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. French labour unions are leading a second day of mass strikes and protests against government plans to raise the retirement age. The country's rail operator, SNCF, SNCF predicts only 1/3 of high-speed trains will run and urge people to actually work from home. Widespread disruption is expected on the Paris subway, with many schools also closed. The International Monetary Fund has raised its global economic growth outlook for the first time in a year. It now sees GDP expanding 2.9% in 2023, 0.2 percentage points more than in its October forecast. The IMF says resilient US spending and China reopening will help shore up demand. And a bomb attack on a mosque has killed more than 70 people in northwestern Pakistan, leaving more than 150 others wounded. The blast happened during afternoon prayers close to Peshawar's police headquarters and other government offices. It's Pakistan's worst such attack in almost 11 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you. Coming up, but it could be no way for Huawei. That's as the Biden administration mulls cutting the Chinese firm off from U.S. tech supplies. More on that story next. This is Bloomberg. The IMF raises its global economic outlook for the first time in a year, but it predicts the UK will be the only G7 member in recession in 2023. France unexpectedly grows in the fourth quarter. GDP rose 0.1%, boosted by investment and net trade. We turn our attention to the wider euro area figures due later. And UBS tops estimates and announces a more than $5 billion share buyback. The chief executive, Ralph Hammers, says shareholder returns are an important part of the business strategy.
If we can grow, we will grow, if that will cost some capital as well. But then it's all about an attractive progressive dividend and a share buyback. And we have confidence that we can buy back over $5 billion in this year.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The Biden administration is said to be considering a full ban on Huawei from U.S. tech suppliers. The move would mark a notable escalation since former President Trump placed limits on imports from the Chinese tech company 4 years ago. For more, we're joined by Bloomberg's Debbie Wu from Taipei. Debbie, good morning and good afternoon. If this ban happens, chip makers like Intel and Qualcomm will be directly impacted. So what does it mean for the companies involved?
So for American companies that's still supplying to Huawei, the impact they're going to feel probably is going to be relatively modest, because after the Trump administration sanctioned Huawei in 2020, American firms have not been able to ship most of their products to Huawei anyways, particularly the most advanced chips. But on the other hand, for Huawei and China, which continue to want to export their technology overseas, this could come as quite bad news, because Huawei will not be able to get chips for its products ranging from PCs and smartphones, and probably its core networking products will be affected as well. And this really would affect their performances and also their ambition to expand their technology influences globally.
Debbie, if this does happen, does this mean geopolitically that actually the U.S. is picking a fight with China right at a juncture where we thought they were getting along better?
Actually, what we have seen over the past month is that the U.S. is working aggressively to make sure that it is containing China when it comes to China's technology development. We have seen the U.S. reaching a agreement with the Netherlands and Japan to limit the exports of advanced machinery to China for chip making. And now we are seeing that the U.S. is trying to further restrict Chinese companies' access to advanced chips. So all the signs are pointing to the fact that the technology war between the U.S. and China are intensifying.
Debbie, thank you so much. Debbie Wu with the very latest on some of, well, the story from Hawaii. PM data from China also shows manufacturing and services expanded for the first time in 4 months in January as a reopening from COVID-0 continued and the Lunar New Year holiday spurred travel and spending. We're now joined by Phoenix Kalen, a global head of emerging market research at Societe Generale. Phoenix, as always, thank you so much for coming on. How do you see the China reopening impacting inflation worldwide?
Yeah, so I think for the inflation picture, the China reopening is going to be very supportive for commodities generally. For oil, we are expecting to see an average price of around $100 per barrel this year, with the potential for that to reach $110 per barrel if there's upside growth potential out of China above what we're forecasting, which is around 5.3% GDP growth for this year. So if there is further impetus on the upside, we can see much more potential for oil prices to be higher. But we think China should also import more LNG, and that could put more pressure on gas prices. And of course, there's the positive sentiment out of the copper market, and that's going to be significant as well. So the commodity complex is likely to put further upward pressure on inflation. I think overall, though, in terms of the impact on inflation spillovers, that is likely to be quite notable for the energy and upstream materials markets. But on the other hand, the impact on CPI on the US or on the euro area out of China reopening is probably going to be not very significant, not significant enough for the central banks there to alter their monetary policy paths.
So, Phoenix, would you say it's actually a welcome boost for, of course, China, but also world growth?
Yes, absolutely. I think the China reopening narrative has really re-energized the kind of investment thesis into emerging markets. And we have seen kind of the incremental inflows start to come back into EM after 3 or 4 years of investors kind of diverting away from the asset class. And we've seen lots of inflows pick up in January. And that is likely to improve now that we've got potentially a much greater growth differential between emerging markets and DM for this year. And I think the lingering concerns around whether or not there's going to be another sell-off in US rates, back up in the long end, those fears have receded to a large extent. They've been replaced, of course, by fears around the extent of the US slowdown. But overall, I think the pressures that come out of the rate cycle from the US is much less on emerging markets. And with yield levels, with currency valuations being a bit more attractive than they were historically, there is still room for investors to start to come back in.
Phoenix, what emerging markets will benefit the most from this? So is it some of the neighboring countries? Could it be Australia? So do we keep it in Asia, or could it also benefit further afield, South America?
Yeah, so we think in terms of the main beneficiaries, of course, of the China reopening, that is going to be some of the regional players. We'll see, out of China tourism, that is going to benefit a lot. Thailand, Hong Kong, Macau, Australia should benefit as well. I think more broadly, because of the support to the commodities complex, that is going to be quite supportive for the LATAM FX in particular. So we are long things like a basket of LATAM FX, including BRL and MEX versus CNH, for instance. So we think the high yielders will still stand to benefit greatly. So LATAM, RAND versus some of the low yielding markets and versus CNY.
Phoenix, when you look at Brazil, I know it's a tough balancing act, especially the fact that we're still trying to really understand, I guess, what the new government stands for. Where do you see opportunities?
Yeah, so we've seen a bit of a back and forth and kind of an own goal happening in Brazil with respect to the president coming out a couple of weeks ago and making statements that appeared to undermine kind of the central bank's independence and their inflation targeting mandate. And we've seen some of the policymakers kind of try to step back from that and walk back some of those comments last week. And so there have been a lot of volatility in the BRL on the back of that, and on the back of still lingering concerns around what the ultimate cabinet will look like and the policies that they will administer going forward, and how radical those policies might be. So the fiscal consolidation trajectory is still a question mark. I think overall, though, given how undervalued BRL is, in real effective exchange rate terms, long run averages, and the kind of growth potential that there is there coming out of the commodity cycle and out of a China reboost, then I think there is still potential for upside in the BRL story.
So if you look at, and I know you've zoomed in on Chile, Colombia, and Mexico, is there more upside on the Mexican currency?
So MEX is certainly not one of the undervalued currencies. It has performed very strongly over the past several years. It's really kind of suffered more recently with respect to the China reopening, where other currencies in LATAM were more favored. And the kind of the traditional long MEX versus other LATAM play petered out more recently, because MEX was more traditionally seen as kind of this safe haven within LATAM. I think MEX can still perform in terms of the more balanced macroeconomics and the fewer kind of economic imbalances that they have in their economy. That can still support MEX as well as from the carrier's perspective. So I think the gains in MEX can be more limited versus other LATAM currencies, but we would still favor being long MEX.
Phoenix, is there something at the moment that seems unnerving? We talk a lot about liquidity. We talk a lot about also default rates, given the pace at which interest rates went higher in the last 12 months. Is there a particularly vulnerable part of the market for emerging markets right now?
Well, so I think it's not all rosy. We have seen valuations come back dramatically. I mean, we've seen, EM currencies appreciating 6% in the space of 3 months. In terms of valuations, it's not as attractive as it was 3 months ago by any means. We've seen, of course, a huge drop in the dollar index, for instance, and how far that trade has reversed. So it's reversed close to 40% of the move up over the past 2 years. Just within the past 3 months is caused that reversal. So I think valuations is a source of concern. And on the other, and also fundamentally, the growth outlook is improving, but it's not spectacular. So the manufacturing PMIs, for instance, are pointing to still some decelerations, very market decelerations out of the developed markets and kind of more stagnation out of the emerging markets. So I think both the direction of travel and the starting point of travel on the manufacturing side are causes of concern. So the growth picture is not overwhelmingly spectacular, and that still is going to be a source of worry for investors looking for places to invest this year. I think, overall, with valuations still slightly attractive and the growth overall improving as we come out of the pandemic and as the war worries start to fade, then there is some upside for emerging markets to attract some of that interest.
Phoenix, thank you so much. Phoenix Kalen, Global Head of Emerging Market Research at Societe Generale. Coming up, a big bank beat and $5 billion in buybacks. We'll hear more from the UBS Chief Executive next. This is Bloomberg. Some breaking news. One of our top stories, of course, that we've been following very closely for the whole week. Adani Enterprises, the share sale of $2.5 billion has been fully subscribed. There were many questions about whether this would be subscribed. We did see some of the royals in the UAE taking a chunk. This is the very latest news coming across the Bloomberg terminal. It has now been fully subscribed. This does not mean overall that the share price will rise in the next couple of days, but certainly for the moment, a bit of reprieve for Adani Enterprises that has gone through a massive shift. I think some $75 billion have been lost in market value. UBS fourth quarter profit beat expectations and said it's planning a share buyback of more than $5 billion this year. That's as rising interest rates helped offset a slump in trading fees as the key wealth management business. Bloomberg's Manus Cranney spoke to the UBS Chief Executive Ralph Hamers.
Indeed, we had a very good set of numbers in the fourth quarter, and not only on the income side, but specifically also on the underlying flow side. 23 billion of net new fee-generating assets, 11 billion of net new money, 9 billion of net new deposits, basically showing the trust of our customers to basically place the money with us and for us to help them manage it. On the back of that, clearly with lower market values on the fee income, that was a bit lower, but the interest income really came through. It is very much the dollar effect and the Swiss franc effect now as well. On the dollar effect, we feel most likely peaked. However, there is more to come on euro and certainly also on the Swiss franc.
Just on those central banks, we caught up 2 weeks ago, and there was the feeling that maybe we're near the top of these central banks in terms of the hiking cycle, specifically the Fed. Paul Krugman joined us yesterday and he said, be careful, stop getting over your skis and overconfident on inflation. Are you overconfident that we've peaked on inflation?
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates, just to be sure. I do think that they are very clear in terms of what they want to achieve. They really want to get the structural inflation down. And that could come along with a real deceleration of economic growth. I think the recipe is that we rather have a short-term pain with a long-term gain than not being tough enough in order to get that inflation back to that level. And that is what I think central banks have in their minds.
In the fourth quarter, you've had some short-term pain. The fees were down 17%, transactions were down 19%. Is that the worst? Is that the nadir of the sidelining of wealth management clients?
Well, if you look at the different components on the wealth management side, so first, what is important is that you see that the trust is there and that clients come to you. That basically shows that we have the right professional services, we have the right products, we have the right advice, we can take them through a period of challenges and unclarity. That period of unclarity is still there, right? So we see positive news coming from China, we see positive news coming on also inflation. We see some life back in the leveraged capital markets, which is normally a leading indicator. However, all early movements. So I don't think there is a trend there yet. So for the moment, I do think that our clients are hopeful, but in a wait and see pattern.
Well, there has been a move to risk on assets. This is the debate. We're 1 month in, there's been a move to risk on assets. You use the word sideline for wealth management clients in the fourth quarter. Are they nibbling? Are they active in acquiring risk on assets? That's
not what we see. We truly see that they are waiting for more clarity to come. And I think that's wise. We really want to make sure that there is more visibility. I do think that the coming weeks will bring that more visibility. We'll see there are central banks coming to the market. We see the New Year's, the Chinese New Year's behind us and see whether the positivism coming from China will continue. We see corporate earnings coming through in the next couple of weeks as well. So I think the next couple of weeks from different sides will give us much more data points to get a feel for should we be risk on or not.
Fit or kill on risk on in the next couple of months. The other aspect for me is the re-leveraging. Every time we get together, you say deleveraging in Asia, deleveraging. Is 2023 going to be the year of re-leveraging given the boom, the sort of the mini boost that we've had from China?
Well, it really depends. So if the investor confidence is there and they are going to go risk on, our investors and our advice will always be, okay, what does leverage cost you? Because you should realize that vis-a-vis the last decade with very low rates, leverage was almost free. Leverage going forward is not almost free. It will come at a cost. So that will be a different perspective in terms of taking on further leverage or not. We do expect at a certain moment that to turn and leverage to come back into the market. In Asia, we've seen more towards the end of the fourth quarter. We've seen some stopping of the deleveraging there. But it's too early to tell whether that's a trend.
UBS Chief Executive Rolf Hamers speaking to our Manus Cranny. Coming up, Ford in Europe, we hear more on how the car maker is handling economic headwinds and cutting its latest EV prices to rival Tesla. This is Bloomberg. Ford recently announced about 3,200 job cuts in Europe to be centered in Germany. That's as the car maker slashes costs to help finance its electrification plans. Bloomberg's Ollie Crook sat down with the company's Model E general manager.
The technology we are using in terms of customer expectation, everything is changing, but it's also extremely exciting because we basically can build a new business. Yeah, our plan is by 2030 to have 100% of our passenger vehicles in Europe being battery electric, and by 2035 all our product range for Ford in Europe will be battery electric. And not only that, but also our whole industrial footprint will be carbon neutral by 2035. And you can imagine a huge amount of investment and change has to go in to make the plant, the logistics, and suppliers to take everyone along on this journey.
It's expensive, it's complicated, there's a lot that goes into it. What are you focused right now on cracking in this transitional period at this point in time?
As you see, it's a huge transition, it's a huge investment, it's a huge project to turn a traditional car company, a traditional production site into a very modern production site. And getting the whole team on board, making the whole team aware of the changes, building the confidence in what the company can actually achieve in these exciting times, that I think is a big task and a great challenge.
And these exciting times, also challenging times in some ways. You know, inflation has been the word of the moment for a while now. A lot of the inputs and the issues going on there. As we shift into an electric world, where there are some ways in which we're much more sensitive to very specific inputs, namely batteries and chips. How do you insulate yourself to those kinds of vulnerabilities?
In general, when it comes to semiconductors, we see the challenges of the last years ease, so supply is clearly picking up. When it comes to the overall resources, I think we need to have a solid plan. We need to have a clear plan on where we want to go in terms of product lineup, in terms of production, and then make sure that we understand the overall supply chain and lock in all the contracts and make sure that we have supply to all the materials we need to put our growth plan into action.
And on the subject of inflation, where do you see costs still being pushed up, and where do you feel that it's gotten better? It sounds like chips, it's improved somewhat. Is that across the board, or are there still places where there's some persistent issues with cost?
In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
That was Bloomberg's Ollie Crook with Ford Model E General Manager Martin Sander. This is the picture for banks across the board. So we had three banks that beat earnings. UBS share price, so a bit under pressure. We had that great report for our Manus Cranny, who also caught up with the chief executive over in Zurich. Now, the key takeaways from UBS's fourth quarter earnings, the chief executive officer wants to keep delivering returns of capital. A bit of concern, so they beat earnings, but a bit of concern about some of the wealth management units going forward. UniCredit giving more back to shareholders, that share price gaining 8%. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
Core inflation measures have shown more persistent, and they have not peaked yet in many countries. And they're still far away from central bank targets.
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates.
The problem is beyond inflation. The problem is the structure of the modern world in which we live.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. UBS does better than expected in the fourth quarter and will buy back more than $5 billion worth of shares. Rising interest rates helped offset a slump in trading fees and transaction income. The IMF sees a turning point in the global economy. For the first time in a year, the fund raises its growth outlook, and the sell-off at Adani Group has wiped off $75 billion in market value, but the flagship's $2.5 billion equity sale is now fully subscribed on its final day. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards is off today. Kailey, we're seeing a little bit of a drop in markets across Europe after a lackluster day in the U.S., to say the least. What are you seeing in terms of Asia?
Well, happy last day of January, Matt. And yes, it does look like we're going to end it on a down note. But we have to keep in mind that it has been a fairly good month for equity markets really around the world. That definitely is the case when it comes to benchmarks in Asia. The MSCI Asia Pacific Index ending January 7.7% higher than it started it, but it did end it with a down day. The MSCI Asia Pacific Index down more than 1% overnight. Even stocks down in China by 1%, despite the fact that we got better than expected economic data. Manufacturing and services PMI for January back in expansion territory, which of course is delineated by that 50 mark. Manufacturing coming in at 50.1, services beating estimates at 54.4, but that not enough to fuel risk sentiment in Chinese equities. As for some individual equity stories to note from Asia, one of them being Samsung. The stock was down 3.6% in South Korea after it reported earnings. Profit in its chip division fell 97%, and analysts and investors seem to be disappointed today that despite clearly the fact chip demand is waning, the company did not announce plans to cut capex. And then, of course, the other stocks we continue to watch are those related to Adani Group. You're seeing some of them, like Adani Total Gas, still losing value today. Adani Enterprises, though, the flagship, up 1.9%. As you said, Matt, that $2.5 billion share sale now is fully subscribed.
All right, we'll continue to follow the Adani Hindenburg story, of course. Meanwhile, in Europe, we had the economy growing 0.1% quarter over quarter. In the fourth quarter, the estimate was for a drop of 0.1%. So better than expected in terms of the overall euro area. We're getting different individual countries reports out as well. But the stock 600 is down right now, about 0.75%. This despite the gains that we're seeing in most of the banks over there. You can see investors are buying the Bund right now, pushing the German 10-year yield down to 2.301%. One bank in particular, UBS, which I talked about at the top, and we're going to focus in on with its $5 billion buyback, did have a slump in trading revenue and transaction fees. As a result, those shares are down 3.5%. But UniCredit, I think, is a better representative of what we're seeing in a number of other banks across Europe. SEB, for example, and Swedbank, all gaining. UniCredit right now up more than 8%. Meanwhile, here in the U.S., after a drop in the cash trade of 1.3% at the close yesterday, we're looking at a drop in futures again of 0.33%. Now, as Kailey pointed out, it's been a pretty good month. I think we're up about 4.6% on the S&P 500 so far this year to date. But we do look like we're going to end the month lower. The U.S. 10-year yield also coming down as investors buy those bonds. 352.53 is the level there, out 5 significant digits. And the Bloomberg U.S. dollar index jumping up again for the third day in a row now at 1227.77. Finally, NYMEX crude as well as Brent falling today. West Texas Intermediate trading for 76.61 a barrel. Kailey?
All right, Matt. Well, let's get back to the European data we mentioned. Bloomberg Markets reporter Valerie Teitel is joining us with the latest. So, Valerie, we've seen some hot inflation from the likes of Spain yesterday, but we also are seeing better than expected growth in the euro area and certain countries within it. How does this change the dial for the ECB?
Well, the bond market surely took a breath of relief after the French inflation number came in line. But it still muddies the picture on what exactly is going on in Europe in terms of inflation. Can we say now that maybe headline inflation hasn't peaked? And to add to that confusion, Kailey, Germany is in the midst of changing the way that they collect their inflation data, and they've actually delayed their inflation prints until next week, which is concerning if you're the ECB and you meet this Thursday. Eurostat Matt has said that they're going to use an estimate for the German number in the euro area print that we get tomorrow. But look, let's not take our eye off the ball here. Core inflation is really what we care about, and we don't really get this breakdown when it comes to the national prints. But given the German number won't really be involved in this core inflation print tomorrow, can we really trust it? Can Lagarde really trust it on Thursday? And given that, would you really be certain in giving us any guidance on how many is in a series? How many 50 basis point hikes can we expect from the ECB? The market is currently pricing 2. But with this overshadowed estimate on the German number, perhaps we have to wait until March when we get their upgraded economic growth forecast to see what they really think.
Valerie, speaking of growth forecasts, the IMF upgraded its growth outlook for the first time in a year. What drove that revision?
Yeah, Matt, the two things that drove that revision were the more resilient U.S. consumer and the fact that China was reopening quicker than expected. But I want to say that these IMF forecasts is part of a quarterly review that they do. And if anything, it just marks a shift in tone. The IMF all last year was really warning of a global economic slowdown, and they've clearly turned the corner on picturing growth being more rosy as we go forward.
All right, Valerie, thanks, Valerie Teitel there. Taking a look at the European data and the revisions that we saw from the IMF. Now, UBS reported fourth quarter profit that beat expectations. The Swiss bank plans to buy back more than $5 billion of its shares this year. The CEO, Ralph Hammers, spoke to Manus Craney earlier.
If we can grow, we will grow, if that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback, and we have confidence that we can buy back over $5 billion in this year.
Manus Craney joins us now from Zurich. So, Manus, the stock is down this morning. Is that all because of the slump that we saw in trading revenue and transaction fees?
Look, definitely, if we look backwards, Matt, fees and transactions down double digits, 17 and 18% respectively. I think where the disappointment comes is there's so much hope, but just very little conviction between the caution from the client and that caution morphing into the courage to actually take on risk asset. I had this debate with a friend in Dubai before I left. I said, look at Tesla, it's up from like $104 to $180. He went, Manny, he said, that is not risk on. He said, that's just risk recovery and short covering. So I think therein lies the problem. They're seeing a minute level of deleveraging stopping in Asia. In other words, that deleverage that we see every quarter when we sit down with Ralph, that seems to have tailed off in the back quarter, just as that China reopening story came out. The question in terms of fill or kill, to quote the market order, in terms of getting those clients to actually move risk on, buy assets, and move from high-yielding certificates and deposits into active embracing of risk, is the magic potion that will deliver the upside. By the way, the $1.65 billion of net income attributable to shareholders, what a mouthful. 35% of that came from interest rate booms. The question is, does that hold through 2023? Kailey.
All right, Manus Craney in Zurich. Great interview. Thank you so much. Let's turn now to Adani Group, and the record $2.5 billion share sale by his flagship company has been fully subscribed on the final day. The feed offers Asia's richest man a reprieve after his empire was rocked by allegations of fraud by short seller Hindenburg Research. Bloomberg's PR Sanjay joins us now from Mumbai with more. So we're now fully subscribed, but Sanjay, PR, that doesn't mean that this saga is over.
Oh, the saga is definitely not over, because one simple research which alleged corruption, money laundering has taken Asia's richest man from the top world's top richest list, and it is also wiped off around over $17 billion of Adani conglomerate, the port to power conglomerate. And now what we are hearing after yesterday, IHC have given a vote of confidence by investing $400 million into the FPO, the follow-on offer. There are many companies, many high-profile investors have invested in the FPO. We understand that the high-profile Indian corporates have also invested in this FPO, and the retail investors are still, that's very poor, but there are few more hours to go to conclude this so-called India's largest follow-on share sale by Adani Group. So one will have to wait and watch whether it will be oversubscribed or not. But however, now after a lot of struggle, it is fully subscribed at this point of time.
Yeah, and we'll definitely continue to keep a close eye on this continuing saga. PR, thanks so much for your reporting. PR Sanjay there from Mumbai. Now, let's get to the auto industry. Ford recently announced 3,200 job cuts in Europe to be centered in on Germany as the car maker slashes costs to help finance its electrification plans. Bloomberg's Oliver Crook joins us now from a Ford factory in Cologne. So, Oliver, what is Ford doing there, and how does it fit into the broader strategy and to the economic picture?
So Matt, we're here in Cologne, this massive production site here for Ford, and as you can see, all these cars behind us, these are all combustion engine cars. And this is really a moment of transition for the auto industry, and this really serves as a nice symbol for that. This factory is being converted into an EV manufacturing site. They'll have EVs rolling off the assembly line by the end of this year. They want every car in this parking lot by 2030 to be an electric vehicle, and they're spending big to do that. $2 billion is going into that here in Europe. I spoke to Martin Zander. He's the man in charge of the electrification push here in Europe, and it comes at a time when you have costs coming up and you have supply chain issues and inflation, as we've been talking about this morning. Here's what he had to say about costs.
In general, when it comes to semiconductors, we see the challenges of the last years ease, so supply is clearly picking up. In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
So maybe not in Spain, but costs coming down, at least in the manufacturing sector here in Germany.
All right, well, let's talk about, as we talk about costs and price, the price of a Mustang Mach-E, which Ford announced yesterday it was cutting. What does it tell us about, A, the company's transition to electric vehicles, and B, whether or not we're going to get an all-out price war among Ford and its competitors?
Well, it tells you a lot about competition right now in the EV sector. This is a sector that, in some ways was ruled by Tesla, had a lot of power over the market. And now, basically, this is a reaction to the Tesla price cut. And you're in a situation now where you have these legacy automakers catching up to Tesla, and Tesla is in some ways worried about that. However, they have large margins. They're able to cut the price, and they're hoping to squeeze these legacy automakers. But it speaks to that competition that's in a market that has not fully matured yet. So you have competition over market share, but you also have competition over basic resources like batteries and chips, both of which are very much in use in EVs. And this is something that is a major focus, not just for the automakers, but for Olaf Scholz this week, who was in Chile and Argentina, trying to secure key parts of the supply chain, lithium, in order to be able to bring this economy into the electric future.
All right, Oliver, thanks very much. Bloomberg's Oliver Crook there reporting from the Ford factory in Cologne, Germany. Thanks very much for joining us. Now, coming up, Jeremy Stretch, CIBC head of G10 FX strategy, joins us to talk about what to expect from central banks and the economies this week. And on emerging markets, we're going to speak with Vivian Lynn Thurston, portfolio manager at William Blair Investment Management. Plus, the Black Swan author, Nassim Taleb, says the path back to normal interest rates may be challenging. More from that exclusive interview ahead.
The net effect that we're going to have normal markets. The road to get there will be very painful for some. And not us, of course, but the situation today, and Mark has pointed it out, we have more debt than we ever did in history. We have the weirdest valuations in history. It's not going to be as smooth as it was for the last 15 years.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. For those of you listening on radio, I'm going to walk you through a very cool Bloomberg function I've pulled up. It's an old favorite of mine, highlighting the relative rotation of sectors in the S&P 500 index. It's RRG Go on the terminal if you want to use it for any index. In any case, what we've seen is very interesting, I think. Healthcare, consumer staples, and utilities are in the lagging quadrant here. Meanwhile, the big gainers are tech stocks, consumer discretionary, and telecoms. That seems pretty bullish to me, unless, of course, this is just a short covering reversal of some tax sales that we had at the end of last year. Let's bring in Justina Lee, Bloomberg Markets reporter, to talk about, what this rotation means. Justina, is it bullish? Should I be excited by this if I'm long?
Yeah, there really has been an incredible risk on rotation this month. I mean, some people might even call it, a dash for trash, because you've had even the most shorted stocks going up and the risky, speculative, profitless tech stocks bouncing back. And I think what that really shows is that it's not just that markets are expecting a slower pace of rate hikes from the Fed, but they're also expecting a soft landing at the same time. Now, the question here is whether this is overly optimistic, given all the economic data we've been looking at.
Well, to that point, Justina, I find it hard to reconcile expectations that the economy is going to be better than expected with expectations that the Federal Reserve is going to have to turn around very quickly and start cutting rates. How do those two things make sense together?
Yeah, and I think some of this might even be self-defeating, because as the stock market rallies, we have seen financial conditions, loosen as well, which is exactly the opposite of what the Fed wants to see. So we also have to see what they say about this phenomenon into this month's meeting. And I think it's really been what the stock market has been telling us has really been counter to a lot of other indicators, such as the yield curve going inverted and the economic surprise index turning negative, and even some earnings estimates are starting to slow.
What do you think about the idea that with the reopening of China, Justina, and things not really as bleak as we may have expected in Europe, we're going to see a big lift to commodities? Because it hasn't really been borne out yet. I noticed WTI was still trading at $76 a barrel today.
Yeah, it hasn't really happened this month. And I think China's reopening is definitely a good signal in that direction. But that's going to take some time to feed through into demand for commodities. Because what we saw in the first wave of China's reopening is a lot of people were still pretty scared to go out and spend. And I think China is still struggling to go out of that phase. But a lot of economists are expecting that we should start to see that in the quarters to come.
And finally, Justina, given it is still earnings season, has there been a clear takeaway from the reports we've gotten thus far as we wait for many more today and over the course of the remaining weeks?
Right. I mean, from a top-down perspective, estimates are coming down, so earnings growth is expected to slow. But one thing that's been kind of interesting that a lot of sell-side strategists have noted is that investors have reacted more to earnings beats, meaning they're rewarding a lot of those companies that have managed to exceed expectations, but they're punishing the misses a bit less. And so that's a bit of a mystery here, but I think that might also speak to the optimism that's in markets right now.
All right, Justina, thanks so much for joining us. Bloomberg's Justina Lee talking us through the changes in sentiment that we have seen and explaining some of the drivers that we could be looking at. For more market analysis, check out MLIV Go, the MLive blog on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Anna Edwards is off today. Now, keeping you up to date with news from around the world, here's the first word. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 continued, and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. Samsung Electronics is defying the downturn in the chip industry with aggressive capital spending. The company is keeping it at last year's level. Rivals have pulled back to alleviate pressure on the battered semiconductor industry. Samsung warned that it expected a recovery in chips to begin only in the second half of the year. The Biden administration is stepping up its crackdown on the Chinese industrial sector. Authorities are considering whether to cut off Huawei technologies from all of its American suppliers, including Intel and Qualcomm. Huawei is long suspected of ties to Beijing's government and the Chinese military. And in Norway, the $1.3 trillion sovereign wealth fund reported its biggest loss since the 2008 financial crisis. The fund lost more than 14% last year. It was hit by rising inflation, credit costs, and the fallout from the war in Ukraine. And we have an interview, Matt, coming up later on this morning with the Norway Wealth Fund CEO. I know that's one you are very much looking forward to listening to.
Yeah, Nikolai Tangen, I have been following his career with curiosity since he became the leader of this wealth fund. He had to give up a lot in order to take this position, and it's not, the lucrative, high-paid job that you would expect that it would be probably in other parts of the world. But in all fairness, he did say it was going to be a very tough job, and he delivered.
Indeed. Well, speaking of tough jobs, central banks this week have a tough job to do as they make their rate decisions. The Fed, the ECB, and the BOE all on deck. We'll discuss it all with Jeremy Stretch of CIBC coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. UBS does better than expected in the fourth quarter and will buy back more than $5 billion worth of shares. Rising interest rates helped offset a slump in trading fees and transaction income. The IMF sees a turning point in the global economy. For the first time in a year, the fund is raising its growth outlook, and the sell-off of Adani Group has wiped off $75 billion in market value, but the flagship's $2.5 billion equity sale is now fully subscribed on its final day. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards is off today, so I will run you through a check of the markets, kicking it off with Europe, as Anna typically does. We're down on the stock 600 right now, about 0.7%, the drop that we're looking at in the cash trade, and investors are buying debt, so pushing the German 10-year yield down just about 2 basis points to 2.301. Meanwhile, UBS shares are actually falling, even after it said it's going to buy back $5 billion of shares. It looks like investors are concerned about the slump in trading revenue and transactional fees. We're going to talk to Manus Cranny about that in just a moment after he interviewed the CEO. The rest of the banks in Europe are doing really well. I think represented perfectly by UniCredit, which is up more than 8%. Interest rates are really helping banks, and others like SEB and Swedbank are also faring well, rising in terms of their share price in trading today. Now, in terms of the U.S., it is, as Kailey reminds me, the last trading day of January of the month, and we're down on futures about 1/3% after coming down 1.3% in the cash trade yesterday. So it has been a pretty good month. We're up 4.6% even with these losses, but it looks like investors are taking some profits off the table. They are also buying debt here, and that pushes the 10-year yield down to 3.5309, going out 5 significant digits. They are bidding up the dollar in what has become really a risk-off sign. So the Bloomberg U.S. dollar index up now to 1228.25 today, and this is the third day in a row of gains for the greenback. So that's not terribly positive for equities. Also, not a great sign in terms of what investors think of the economy is NYMEX crude coming down again today, $76.72 a barrel. Brent is falling as well. So, Kailey, it looks like there's some concern about economic growth, even with the IMF raising its forecast.
Yeah, that definitely still seems to be lingering out there. And you're seeing concern about perhaps the idea that we saw some stocks running too far, too fast, now trickling into losses, potentially for a second day for some of these companies like Lucid Group, which of course is an EV maker. It fell more than 6% yesterday after research group Fuzzy Panda said it is short this stock because it thinks the buyout rumors from Saudi Arabia's public investment fund are not true. So that stock is down another 4%. Remember, Lucid had rallied 65% last week on those reports. Fuzzy Panda, yes, I had to Google it. It is a research firm. Also, a lot of Google images of stuffed panda toys came up in that Google search. Elsewhere in the EV world, Tesla is down for a second day, too. It's down the better part of 2% in pre-market trading this morning. So unwinding some of that really remarkable gain we saw for the stock last week, which was the best for the stock going back to 2013. I want to note some chip makers as well. NVIDIA saw its 6-day winning streak snap yesterday. All that AI-fueled boom in the stock seems to be coming to an end. It's down another 1.6%. And then another chip maker, the second largest maker of PC processors, AMD, is going to be reporting later today, down 1.6%. Ahead of those results. Remember, if Intel is any clue, Matt, the PC market is really, really weak. So we'll see how that fares when we get that report from AMD later on today.
All right, looking forward to that. Let's talk now about the economy and central banks. Joining us to do that, Jeremy Stretch, head of G10 FX strategy at CIBC. Jeremy, obviously, it's a huge week for central banks, and this is what has really been driving the markets across asset classes. What do you expect from the Fed tomorrow? Are we going to get a really hawkish 25 basis points?
Yes, I think that's what Chair Powell is going to try and push through the market. Clearly, he's going to try and walk the tightrope of saying that the Fed are getting nearer the inflection point in terms of policy adjustment, but we're not there yet. But more importantly, he would try and push back against that market pricing for rate cuts in the second half of this year. So I think it is going to be this hawkish narrative that he's going to perpetuate from December, and I think markets will remain relatively nervous going into the event. It may well be the case that the dollar has a little bit further to travel in terms of gains, but I think it's still a case that we can actually look to fade those rallies because ultimately we're getting close to that end game as far as the Fed tightening cycle is concerned.
In terms of the ECB, do you expect them to be more hawkish? Because we've really seen a turnaround in the currency, and it looks like investors are betting that the Fed can pause while the ECB will continue to hike at 50 basis point meetings.
Well, if you go back to December, the ECB narrative was very much the steady and significant mantra, and that implies 50 basis point clips in terms of monetary tightening. And when you look at the underlying macro story in the Eurozone, it has materially improved from where we were back in the autumn, when we were very concerned about both gas prices, but also the risks of gas rationing. So those IMF upgrades that we've seen released overnight did actually produce a small upward momentum or degree of expansion in terms of the German economy. And I think that gives the ECB a little more latitude. So I suspect this week's meeting will be very much a 50 basis point clip, leaving the market assuming and anticipating another 50 basis points in March. But I think that March meeting will be much more important because, of course, that comes with the updated and uprated staff forecasts. And I think that will be much more significant in terms of the policy dynamics. But for now, the ECB is deemed to be much more hawkish than the Fed.
And yet it's interesting because you have perhaps equally remaining strong data on both sides that you could point to, Jeremy. The idea being that why would the Fed slow things down or feel the need to pivot anytime soon when the ECB doesn't?
Well, I think in a sense, you also need to reference what a pivot means, because, of course, the Fed is slowing the pace of tightening at this meeting. It isn't necessarily sanctioning or warranting a discussion about a rate cut, which in a sense is a full definition of a pivot. But I think the Fed have been tightening policy very aggressively, and there are now significant signs that some of those inflationary influences are starting to moderate, not fully, but moderate, and the labour market is an issue. But I think in the Eurozone dynamic, there is still significant degrees of inflation stickiness, particularly in terms of core prices. And I think in the course of the next 24 hours or so, the markets will be monitoring both the release of the German flash inflation data later today and the Eurozone metric tomorrow. After that, upside surprise in Spain yesterday, which did cause the market a degree of consternation as to whether the inflation profile is going to be a little bit stickier in the Eurozone than compared to the US.
And there's one more area or central bank we need to talk about this week. That would be the Bank of England. You are against consensus, seeing a 25 basis point hike this week. Why?
Yes, that's right. I think if you look at pretty much all of the real economy data, and we've just seen this reflected in terms of the mortgage approvals and consumer credit numbers this morning, pretty much all of the real economy data has deteriorated and deteriorated very sharply. Yes, average earnings are still running at very elevated levels, but I think there are starting to be some signs that the labour market is also starting to moderate. And I think the Bank of England's inflation profile still suggests that the inflation dynamics are still set for a substantial correction over the course of the 2-year time horizon. The UK's inflation profile is slower to fall, yes, compared to its counterparts, but I think the real economy data is going to be very challenging in terms of demand-driven inflation. So I think that gives the opportunity and the latitude for the Bank of England to slow the pace of policy tightening. But I think we will get a very elevated degree of split across the MPC once again this week. And I wouldn't be surprised if we once again see a three-way split in terms of the voting patterns. But we're looking for 25 basis points and accordingly looking for sterling to suffer and the rate profile to be impacted accordingly.
Jeremy, what are the most interesting pairs that you're following right now? What gets you excited when you wake up in the morning and head off to CIBC?
Well, I think certainly from the sterling dynamic in the context of that out of consensus call in terms of the Bank of England, I think is a currency that we continue to monitor. We like in the short term just fading the euro rallies above north of 109 because I think there are better levels to come back to euro. And if we are going to see a more constructive euro backdrop across the year ahead, then I think you can perhaps look at some of the leverage plays off the Eurozone, and then that takes you back to someone like Sweden. So I think there are plenty of opportunities outside of the dollar perspective and dollar sphere in terms of interesting currency pairs moving forward.
All right, excellent. Thanks so much for your insight this morning. Thanks for joining us. Jeremy Stretch, their head of G10 FX, talking to us from our London offices. He's from CIBC. Coming up, Vivian Lynn Thurston, portfolio manager at William Blair Investment Management, is going to join us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with General Motors CFO Paul Jacobson. That's at 7:30 a.m. New York time, 12:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Anna Edwards is off today. Well, China's reopening is set to provide a welcome boost to global growth, offsetting weakness in Europe and a looming possible recession in the U.S. But there is a catch. A boost to inflation at exactly the moment the Federal Reserve and other central banks race to bring it under control. That's the topic of today's Big Take. And to join us to discuss it further now is Vivian Lynn Thurston, portfolio manager at William Blair Investment Management. Vivian, thank you so much for joining us. When you think about China, and we got better data out of China today in the form of manufacturing and services PMIs, how do you weigh the growth impulse against the possible inflationary one?
Yeah, thank you, Kailey. That's a very good question. And first of all, we do believe that the reopening will lead to the recovery of China consumption and normal economic activities in 2023. But in terms of the impact on inflation, I think it could be more moderate than we expected, or as we have seen in the Western world or other part of the world when the reopening happened. So if we look at the China current CPI, it's pretty moderate, about a little bit over 2%. And that has been the case throughout the early reopening time in 2020. Part of the reason that China structurally has a little bit lower inflation, given that digital economy is a very big part of the economy, therefore always function as a price deflation factor. And secondly, Chinese manufacturers tend to absorb quite a bit of the price increases on the raw material side. Therefore, we have seen the PPI probably pretty high or elevated for some period of time, but CPI has been moderate. So the debate will continue to go on about the reopening of China. How does that impact the global inflation? But my thinking is that it could be more moderate.
Vivian, can you look at what happened in Europe? Can you look at what happened here in the U.S. and take lessons from our trajectory and apply them to what you may expect in China?
Yeah, I do think from incremental perspective, China will see some increase of inflation, given that it's still very moderate at this point. But I do not see that this will be the same magnitude as we have seen in the U.S. So from the wage inflation perspective, U.S. was a very big driver at the beginning of the inflation surge. In China, we will probably see some wage inflation from a lower tier kind of employment. But overall, the employment level has been quite healthy. The unhealthy part was more the younger generation youth employment. So unemployment rate was about 20% at one point for this generation. And that definitely will impact the service side of the inflation. But overall, I think the structure of the employment or unemployment rate in China will also make the inflation more moderate than we have seen in the U.S.
Let's talk about how all of these economic factors factor into actual equity prices, because we have seen a remarkable rally for so many of these stocks. I mean, the Hang Seng Tech Index is up 70% from its lows in October. So I guess the question is, Vivian, how much of the reopening news is already baked in?
Yes, first of all, this is from very, very low trough. I think that's bottomed probably the end of October. So if you look at in the last 2 years period, even with the recent rally, Hang Seng and MSCI China is still at a pretty low level. So I would say the first leg of the kind of improvement due to the sentiment repairment is taking place. But going forward, I think the driver will come from the earnings recovery. And I think that won't come until probably from the second quarter of 2023. So I do think there's still more to come for the overall equity market, even though I think in the short term we may see some consolidation given the very strong run-up in recent times.
Vivian, for many months now, we've been talking to portfolio managers who are fascinated with India. They think it's the next big thing. It's got a growing population, about to eclipse China, a much younger demographic, and it seems that all of that has now soured with the Hindenburg research release on Adani. What's your take on that saga and how it shifts flows from China to India and now possibly back again?
Yeah. India remains a structural growth story from our perspective. You just mentioned a few key drivers, where the rising middle class consumption and also the country continue to pursue for this made in India kind of strategic focus. So those structural factors actually have not changed. And this will continue to be a very good support for Indian equities going forward. But if you look at Indian equity, one key risk is that valuation was very high. Indian equities always trade a premium to the MSCI emerging markets equities. And I think towards the second half of last year, that premium even enlarged. So it's not surprising that we see a little softness of the Indian equities in recent times.
But you're not. So Vivian, you're not put off by the Hindenburg report on Adani. You don't see it as an attack on India at large.
I think that's more company specific idiosyncratic kind of development. Even though I think the spillover effect needs to be watched closely, whether this will impact some of the banks, which have some kind of the lending activities with the company. But overall, we don't see this as a big kind of a contagion effect for all companies or the economy of India to that extent.
Excellent to get your thoughts, Vivian. Thank you so much for joining us. Vivian Lynn Thurston there of William Blair Investment Management. Coming up, the author of The Black Swan has a warning about the road back to normal. Part of our exclusive interview with Nassim Taleb next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Anna Edwards is off today. Now let's take a look at what Anna is missing coming up in the day ahead. At 8:30 a.m. Eastern Time, we'll get an insight into wages and salaries in the U.S. with an update on the Employment Cost Index. Then there's some more data at 10 a.m. with the latest consumer confidence numbers. And finally, it is a big earnings day. Exxon, Pfizer, McDonald's, and Caterpillar are all among companies scheduled to report earnings before the opening bell, Matt.
All right, I'm sure Anna has other things to focus on, or at least I hope that she does instead of the employment cost index. But we will be watching it very closely. Also, the Black Swan author, Nassim Taleb, says the stock market is way too overvalued for the current interest rate. Taleb spoke exclusively to Bloomberg's Sonali Basak in Miami.
Our strategy at Universa does not depend on what we think of the stock market. So it doesn't change whether Brandon believes that it's going to be rosy forever and Mark, or whatever. It doesn't, or if you think that so the strategy here is not about timing markets or environment. There's a structured policy of having geometric payoffs and the tails. But to go back to the environment, I believe that the stock market is way too overvalued for interest rates that are not 1%. So unless they miraculously bring back interest rate to 1%, which they won't be able to, you will have interest. I mean, it's unsustainable. Why should you put your money in a stock that gives you 2% dividend yield, if you're lucky, when you can get 4.75% from the bank while playing golf? Explain to me, right, the logic, right? So this is why the stock market has to adjust to normal levels. And again, we haven't had that much growth over the past 25 years to justify this valuation. So it's just there.
Sonali joins us now from Miami, extremely early in the morning, especially for that part of the world. Sonali, I think this is fascinating, especially considering your reporting on Mark Spitznagel yesterday. The two of them have worked together in the past, and they're both worried to some extent about, to an enormous extent, about the global debt situation.
It was interesting because Mark Spitznagel wasn't there, and Nassim Taleb actually, to my knowledge, had not read his letter. But they had two different ways of describing a similar situation. Mark Spitznagel, in a letter to investors that I had obtained, had described it as a tinderbox time bomb akin to the 1920s, where the global debt load, particularly in corporate debt, fueled by central banks, has ballooned to the point that it sets up conditions similar to the 1930s Great Depression era. But then you have Nassim Taleb, who described it differently and explained it as something like a tumor. He explained it as something that is kind of deep and burning inside the markets that will have longer term ramifications. And he described that for things like crypto. He described it in terms of the stock market and how many companies there are without cash flow. And he described it in terms of real estate. So there were definitely certain areas, you and I might call it a bubble. He calls it a tumor. Mark Spitznagel calls it a tinderbox time bomb.
I prefer a tinderbox time bomb, frankly, to a tumor.
Wow, right. What language?
When does this time bomb go off? Did either one of them give you any indication, or what's going to set it off?
That's the great debate. This is the Black Swan author we're talking about when we're talking about Nassim Taleb. And one thing I asked him was, you think about 2020 when you had a return on their invested capital in a month of 3,600 or more based on the insurance return that you were getting on their strategy. But you look at over time and the return on compounded annual growth rate, so that's a completely different measure, is about 10.4%. In 2022, they didn't provide their returns. And 2022, over the full year, you had one of the worst years you've had in more than a decade in the S&P 500. When I asked him what was the difference, he said the difference was the shock of a return you got in 2020 versus the controlled burn, as Mark Spitznagel said it was in 2022. So the payoff is different, and it's spurred this huge debate on what is a hedge fund, what is it supposed to do to you, for you, and what kind of return are you looking for at the end of the day? Because CTAs, trend followers, huge kind of competitor in the market to a firm like Universa, made a lot of money last year. But Spitznagel argued that had not made you a lot of money over the past decade.
All right, Sonali, we have to leave it there, but thank you so much for waking up early for us. Have a good day down there in Miami. Bloomberg Sonali Basak, we appreciate it. And Sonali mentioned she was talking about crypto with Nassim Taleb. We'll tune in for more crypto talk today on Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. in London. Our weekly show with Matt and I covers the people, transactions, and technology shaping the world of decentralized finance. That wraps it up for Early Edition. More surveillance is ahead, including conversation with Nikolai Tangen, Norges Bank Investment Management CEO, among others. This is Bloomberg.